Private equity, it sounds like something reserved for Wall Street insiders, right? Well, today we're going to break it down in simple terms and dive into how private equity really works. And we'll be talking about the biggest players in the game: Blackstone, KKR, and Apollo. So if you're curious about how private equity firms turn businesses into big profits, stick around. This is for you. First off, let's answer the basic question: what is private equity? Private equity, or PE, is all about investing in private companies or buying public companies and taking them private. The goal? To improve those businesses and eventually sell them for a big profit. These firms raise money from investors like pension funds, wealthy individuals, or even governments to form what's called a fund. Then, they use that fund to invest in or buy companies. But how does a private equity deal work? Let's walk through the steps. Step 1. Raising capital. Private equity firms raise capital from institutional investors, like pension funds and endowments, plus high net worth individuals. For example, Blackstone might raise billions of dollars for a fund that will be used over several years to buy companies. Step 2. Finding investment opportunities. Once the fund is raised, the firm looks for companies to invest in. These are usually businesses that have potential for growth, but might need some restructuring, cost-cutting, or better management to reach their full potential. Let's take an example. Suppose Blackstone spots a manufacturing company that's struggling with inefficiencies. They believe with better management and strategy, this company could be much more profitable. Step 3. Acquisition. The private equity firm makes an offer to buy the company, often using a combination of the fund's money and leverage. That's a fancy word for borrowed money. Private equity firms often take on debt to make these acquisitions, which magnifies potential returns. This is called a leveraged buyout, or LBO. The idea is that with the right changes, the company will grow, the debt will be paid off, and the firm will sell the company at a profit. In 2007, KKR famously led a leveraged buyout of TXU Energy, one of the largest in history. Step 4. Restructuring and growth. Once the firm owns the company, they get to work. This could mean changing management, cutting costs, improving operations, or even making strategic acquisitions. The private equity firm might hold on to the company for several years, focusing on boosting its profitability. For example, Apollo took over Hostess, the company famous for Twinkies, when it was going bankrupt. Apollo restructured the business, cut costs, and improved distribution. In just a few years, they sold Hostess for a significant profit. Step 5. Exit. After several years of making improvements, the private equity firm looks for a way to exit the investment. They could sell the company to another firm, take it public through an IPO, or sell to a strategic buyer in the same industry. In 2019, Blackstone sold its stake in Hilton Hotels for a massive profit, after holding the company for over a decade. They bought it for around $26 billion in 2007, made operational improvements, and took it public. By the time they sold their stake, it was worth over $14 billion in profit. Now that you understand how private equity works, let's take a closer look at the three biggest names in the industry: Blackstone, KKR, and Apollo. Blackstone is the largest private equity firm in the world, managing over $1 trillion in assets across private equity, real estate, and other investment areas. Founded in 1985 by Stephen Schwarzman and Peter Peterson, Blackstone has made massive deals in industries like real estate, hospitality, and technology. One of their most famous deals was their acquisition of Hilton Hotels in 2007. Despite the financial crisis hitting shortly after, Blackstone improved Hilton's operations, expanded its reach, and made billions when they eventually sold their stake. Assets under management, AUM, over $1 trillion. Revenue, 2023, $10.87 billion. Net income, 2023, $2.45 billion. Key financial drivers: diversified revenue streams. Blackstone is the largest private equity firm in the world, with investments spanning across real estate, private equity, hedge funds, and credit markets. A significant portion of Blackstone's earnings comes from its management and advisory fees, which provide a stable income stream even during downturns. Real estate dominance. Real estate makes up a major part of their portfolio, contributing heavily to their earnings. In Q2 2023, Blackstone's real estate division contributed 48% of its total distributable earnings. Global reach. Blackstone operates on a global scale, investing in over 40 countries, and has capitalized on opportunities in both developed and emerging markets. Their ability to navigate diverse economic conditions has helped them outperform many peers. Investment strategy. Blackstone's focus on large-scale buyouts and its significant real estate portfolio allow it to capture both steady income and substantial capital gains. Their disciplined approach to capital deployment has resulted in significant long-term value creation, as seen with deals like Hilton Hotels and the Weather Channel. Outlook. Blackstone's continued focus on infrastructure and technology sectors, combined with its resilient real estate portfolio, suggests it will remain a dominant force in the PE world. However, challenges could arise from its large exposure to the real estate market, especially during economic downturns. Next, we've got KKR, which stands for Kohlberg Kravis Roberts. KKR is famous for pioneering the leveraged buyout model in the 1980s. Their most famous deal? The acquisition of RJR Nabisco in 1989 for $31 billion. It's considered one of the largest buyouts in history and was the subject of the book Barbarians at the Gate. KKR focuses on buyouts, growth equity, and infrastructure projects with billions under management and a reputation for bold, high-stakes deals. Assets under management, AUM, $510 billion, revenue 2023, $7.48 billion, net income 2023, $2.15 billion. Key financial drivers, leveraged buyouts, LBOs. KKR is known for pioneering the leveraged buyout model, and LBOs remain a cornerstone of its strategy. Its historical focus on mega deals, such as the acquisition of RJR Nabisco, demonstrates its ability to leverage debt to generate outsized returns. Capital markets and insurance. KKR's expansion into capital markets and insurance through its acquisition of Global Atlantic has created additional stable revenue streams. Insurance provides recurring premiums, and this diversification has helped mitigate market volatility. Operational efficiency. KKR takes an active role in managing its portfolio companies, focusing on operational improvements and cost reductions. This hands-on approach has driven value creation across its portfolio. Investment strategy. KKR focuses on buyouts, growth equity, and credit. Its strategy includes long-term partnerships with management teams, active involvement in improving operations, and careful capital structuring. In recent years, KKR has expanded into infrastructure and healthcare investments, positioning itself to benefit from long-term secular trends. Outlook. KKR's strong reputation in buyouts and increasing investments in growth sectors such as technology and healthcare will continue to drive its performance. However, its reliance on leverage can expose the firm to risk during periods of rising interest rates or credit market disruptions. Finally, we have Apollo Global Management. Apollo, founded by Leon Black in 1990, is known for buying distressed assets, companies that are struggling financially. Apollo's strategy is all about finding value in companies that other investors may have given up on. They've made successful turnarounds in industries ranging from hospitality to retail. One of Apollo's most successful deals was their acquisition of Hostess in 2013. The company was on the brink of bankruptcy, but Apollo turned it around and sold it for a significant profit just a few years later. Assets under management, AUM, $600 billion, revenue, 2023, $7.97 billion, net income, 2023, $1.8 billion. Key financial drivers, distressed asset, expertise. Apollo specializes in buying distressed assets, turning struggling companies around and generating significant returns. The firm's ability to identify undervalued or distressed opportunities has been a hallmark of its success. Credit and yield-oriented strategies. Nearly 70% of Apollo's assets are in credit and yield-generating products, making it less reliant on traditional private equity buyouts. This focus on credit strategies has provided a stable income base. Large-scale transactions. Apollo is known for executing massive transactions, such as the buyout of Lumen Technologies and the acquisition of Athene Holding, a retirement services company, which has bolstered its insurance platform. Investment strategy. Apollo's strategy revolves around distressed buyouts, opportunistic credit, and yield-oriented strategies. It typically invests in companies that are undervalued or facing operational challenges, restructuring them to increase efficiency and profitability. Their acquisition of Athene has created a strong pipeline of assets with a focus on retirement services and life insurance. a move that diversifies their revenue streams. Outlook. Apollo's expertise in distressed investments positions it well for periods of economic downturn, as it excels at finding value in challenging environments. However, its high exposure to credit markets could pose risks during times of increased interest rate volatility. And we can't forget about the Carlyle Group. Founded in 1987, Carlyle is another major player in private equity, managing over $375 billion in assets across a wide range of industries, including aerospace, healthcare, and technology. Known for its global reach and influence, Carlyle has invested in companies like Booz Allen Hamilton and Hertz. They focus on long-term growth, often working closely with management teams to drive improvements. Carlyle's ability to spot undervalued companies and turn them into success stories has cemented its place as one of the most respected names in the industry. Assets under management, AUM, $385 billion. Revenue, 2023, $4.42 billion. Net income, 2023, $940 million. Key financial drivers, global diversification. Carlyle has one of the most globally diversified portfolios in private equity, with investments spanning North America, Europe, Asia, and Latin America. This geographical diversity allows Carlyle to mitigate risks associated with regional downturns and capture global growth opportunities. Sector-specific expertise. Carlyle is known for its deep sector expertise, particularly in aerospace, defense, healthcare, and technology. This focus allows Carlyle to make highly informed investment decisions in specialized areas where it has an edge. Strong fundraising capabilities. Carlyle continues to attract significant capital from institutional investors. The firm raised $17 billion for its 8th U.S. buyout fund, one of the largest in recent years, highlighting the confidence investors have in Carlyle's ability to generate returns. Investment strategy. Carlyle focuses on buyouts, growth equity, and real assets. Its strategy of sector specialization allows it to make targeted investments where it has deep expertise. In addition to traditional private equity, Carlyle invests heavily in infrastructure and real estate, offering a broad range of investment options. Outlook. Carlyle's strong position in high-growth sectors like technology and healthcare, combined with its global presence, positions it for future success. However, challenges in the broader private equity space, including rising competition for deals and higher valuations, could impact returns. While all four firms have different strategies, they share a common goal: maximizing returns through operational improvements, strategic acquisitions, and smart financial engineering. Their ability to navigate complex market conditions will determine their continued success in the evolving world of private equity. Now, private equity has its upsides, but it's not without controversy. On the plus side, private equity can save struggling companies and provide a boost to industries that need new management or fresh ideas. But critics argue that private equity firms can sometimes focus too much on short-term profits, leading to layoffs, cost-cutting, or loading companies with debt that's hard to manage. The KKR-led buyout of TXU Energy is a classic example. After the firm acquired the company, it struggled under heavy debt and eventually filed for bankruptcy. So, is private equity good or bad? Like most things in finance, it's complicated. It can create huge returns for investors and improve companies, but there's also a risk that too much focus on profits can hurt businesses in the long run. To sum it up, private equity is all about using capital and expertise to improve companies and generate profits. Firms like Blackstone, KKR, and Apollo are the biggest players, making multi-billion-dollar deals that can reshape entire industries. If you found this video helpful, make sure to give it a like, and hit subscribe for more breakdowns of how finance and business really work. See you in the next one. Get ready for another knowledge drop. Outro music with on-screen text. Subscribe for more business insights.